In 2009, you could buy a piece of America's biggest banks for less than the furniture in their lobbies was worth. On paper. Think about that. The market was pricing these companies below the value of what they actually owned. That's not a typo. That's a signal. I've spent 50 years watching this pattern repeat. Fear takes over. Prices collapse. And suddenly, solid companies trade for less than the stuff on their balance sheet. There's one ratio that helps you see it: price to book. It's the tool Benjamin Graham built his fortune on. But here's the catch: it fools more beginners than almost any number in investing. Let me show you how to use it right, and the trap that cost even Warren Buffett. Draw, assets minus liabilities, arrow, book value. Let's start simple. Book value is just what's left if a company sold everything it owns and paid off everything it owes. Assets minus liabilities. That's it. Imagine you own a lemonade stand. The stand, the cash, the lemons, that's your assets. The money you owe your sister for startup cash, that's your liability. Subtract one from the other, and you've got book value. Draw, lemonade stand plus cash plus lemons, arrow, assets. Oh, sister, arrow, liabilities. Now, the price-to-book ratio compares the stock price to that number. If a company's book value is $100 million, and the whole company trades for $100 million on the market, the ratio is 1. Trade below book, and the ratio drops under 1. That's when value investors start paying attention. Right, below 1.0 equals the market values at less than its own net assets. Graham loved this. He hunted for companies trading below the value of their cash and inventory alone. He called them net-nets. But there's a reason that's harder today, and it leads straight to the biggest mistake people make. Here's where it gets uncomfortable. A low price-to-book ratio doesn't automatically mean bargain. Sometimes it means warning. In 1965, Warren Buffett bought control of a company trading below its book value. A textile mill called Berkshire Hathaway. Sound familiar? Yes, that Berkshire. The numbers looked cheap. The business was dying. American textile mills were getting crushed by cheaper overseas competition. Buffett later called it the dumbest stock he ever bought. He estimated that mistake cost him around $200 billion in lost compounding over the decades. $200 billion. Because he anchored to a cheap ratio instead of a great business. So what's the lesson? A low price to book only matters if the assets are actually worth what the books say. A factory full of outdated machines? Those assets are worth far less than the balance sheet claims. And that is the difference between a bargain and a trap. Draw, low PB arrow, great business equals bargain. Low PB arrow, dying business equals trap. So when is this ratio genuinely useful? For asset-heavy businesses, especially banks and insurers. Their balance sheets are mostly cash, loans, and securities. Things you can actually value. That's why price-to-book is the go-to metric for financial stocks. Back to 2009. During the financial crisis, panic drove bank stocks far below book value. Bank of America hit $3 and change. The market assumed these banks were going to zero. But some weren't. In 2011, Buffett invested $5 billion into Bank of America. He saw a franchise the market had left for dead. Over the following years, that stake grew into one of Berkshire's most profitable investments. Now, why doesn't this work for a company like Apple or Coca-Cola? Because their real value isn't on the balance sheet. It's the brand. The customer loyalty. The pricing power. Coke's secret formula and global brand are worth hundreds of billions, but accounting rules barely record that. So their price-to-book looks sky-high, and it tells you almost nothing. Draw, brand plus loyalty plus pricing power, arrow, invisible on books. Which brings us to the smartest way to use this number. Never use price-to-book alone. Ever. It's one lens, not the whole picture. Here's my 3-step filter. First, ask if the business is asset-heavy. If it's a bank or insurer, the ratio means something. If it's a software company, be skeptical. Right, step 1, is it asset heavy? Second, check if the assets are real. Cash and marketable securities? Trustworthy. Old inventory, outdated equipment, or goodwill from overpaying on acquisitions? Discount those hard. Third, is the business growing or shrinking? A cheap price to book on a company gaining ground is opportunity. On a company in decline, that's Buffett's textile mill all over again. And always pair it with the return the company earns on that book value. A bank earning strong returns on equity, trading below book? Now you might have something. This is educational, of course, not a recommendation to buy anything. Always do your own research. Here's the one thing to remember. Price to book doesn't tell you if a stock is cheap. It tells you where to start looking. Graham said it best, price is what you pay, value is what you get. A low ratio is a question, not an answer. Your job is to figure out whether those assets are treasure or trash. Right, a low ratio is a question, not an answer. So let me ask you, have you ever bought something just because it looked cheap and regretted it? Tell me in the comments. I read them. And if this changed how you see a bargain stock, hit subscribe. We do this every single day. Tomorrow, we're breaking down return on equity, the number that separates real businesses from value traps. See you then.